Good evening. Welcome to Mongo Spaces this evening. Our host for the day is Julian.
Ladies and gentlemen, thank you so much for creating time to be part of this conversation this evening from Nairobi time. We want to get into a deep dive on matters regarding the budget for financial year 2024-25, which of course runs from the period July 1st, 2024 until June 30th, 2025. This conversation will be structured in three parts. The first part will basically be a review, and here we shall be looking at the Supplementary Budget Estimates II, which, by the way, the appropriation bill was signed into law this morning by President William Ruto, and that will basically be focusing on the tail end of the current financial year, which has a couple of weeks left. Segment 2 will be focusing largely on the estimates for financial year 2024-25, looking at the finance bill and the proposed revenue-raising measures as the nexus between the national tax policy and the medium-term revenue strategy. Part 3 of this conversation will be skewed towards a more broader macro review. We shall be looking at things like the IMF program. We shall be looking at the performance of the GDP so far in the current financial year and what the outlook is beyond the IMF program, whose sunset date is March 2025. Therefore, it tells us it should be lapsing in the next financial year. To help me navigate this conversation, I have an esteemed panel, and I need to begin by conveying an apology from Churchill Ogutu, the economist from IC Group, who, because of unavoidable circumstance, will not be able to join us. But nonetheless, we shall carry on with the conversation. So, with me, I have Ruth Mwiti, who's a tax consultant. Ruth, are you able to introduce yourself, please?
Yes, good evening, everyone. Good evening, Julian. I'm Ruth Mwiti, a tax consultant, and I'm happy to be here.
Many thanks, Ruth, for joining this conversation. Nicholas Kahiro from PwC, and we shall also be joined by Kimani Stephanie, who's also an economist. So we shall allow that is Stephanie and Nicholas to join into the conversation, and we shall be continuing with them on board as and when that happens. So now that I'm with Ruth Mwiti, let me just begin by setting the context. We are at the tail end of the budget cycle, and that is the structuring cycle for the budget for the financial year 2024-25. We are now currently discussing matters regarding the finance bill and the appropriations bill. The finance bill being the revenue side of the budget, the appropriations bill being the expenditure side of the budget. And that is the point that leads up to the much anticipated budget statement, which will be tabled in the National Assembly, and the speech delivered by none other than the Cabinet Secretary for the Treasury, that is Professor Njuguna Ndung'u, on Thursday this week, starting 3 p.m. And just to set the context around this, let me kick off with Ruth, who's with us. Remember, the part 1 of this conversation is basically a review conversation. So, Ruth, in the latest numbers that we have seen regarding Supplementary Budget II, we have seen a massive revenue target downgrade by about 250 billion shillings coming from the National Treasury, and that is for the current financial year, which is 2023-24. And the question here is, what signaling is being done here? What are we being told about, 1, the state of the economy, and 2, Finance Act 2023, because remember when this was passed, there was the indication that it targeted raising a staggering 211 billion shillings. Ruth, what are your thoughts around this? Maybe before I even get to the question, I can see Stephanie has joined us. Stephanie, can you please introduce yourself?
Hi, so I'm Stephanie Kimani, an economist and also a strategist, and I'm glad to be here.
Thank you. Thank you for the intro, Stephanie. I just want to jump back to the question I was posing to Ruth as we kicked off our conversation. I began by focusing on the latest numbers we have seen with regard to Supplementary Budget II, 2023-24. We've seen a revenue downgrade by about 250 billion shillings. And my question here, Ruth, is when you look at that, what statement is being put across by the National Treasury? 1, with regard to the overall state of the economy, and also when you look at the performance of the economy and Finance Act 2023. That's quite a sizable downgrade from a revenue yet. Ruth?
Thank you, Julian. I think for me, maybe just to first comment on the issue of the Finance Act 2023, we saw major changes, in some of which were not supported by many Kenyans, but somehow government managed to push through them things like the housing levy, other things like the ETIMS compliance for all taxpayers, vatable or non-vatable. And the question that is always arising is government listening to Kenyans, and as the government also gives its targets on how to raise revenue, are they considering the common mwananchi? My thinking obviously is yes. The target is to get to the citizens who are not paying tax, but you realize that as the government is doing that, you're also discouraging other taxpayers from complying or pushing them out of the economy in the hope that you will get these other taxpayers that are being targeted, the job sector, into paying. So my view is that, yes, the government wants to raise revenue, but what is necessary is to make sure that you listen to what Kenyans are saying. And also the key, most important thing is to manage the expenditure. Because yes, you will raise, but how are these funds being utilized? Is the government being accountable enough to say that last year, this is the much that we received, and this is how much we spent, and this is how we have managed to control our spending? Because my thinking is that if expenditure is well managed, the revenue that is collected could be enough to take us to the next level as a country. But you push payers to the wall and then you're not accounting for those funds, then there is something wrong. But we are hopeful that we will see a change based on the fact that Kenyans are really keen on the budget making process. They are keen on the finance bill recently, last year and this year. So that is a way to say that as much as government might not listen, somehow they will have to listen in the near future.
Thanks, Ruth. Let me bring in Stephanie at this point. And Stephanie, we're kicking off by focusing on Supplementary Budget II because that sets the context then for the next financial year. And 2023-24 has been a challenging year from a revenue standpoint. The outstanding revenue to Q3 is about 208 billion off target. And the question that has emerged here is, traditionally, we have seen a bumper revenue collection in June, which tends to salvage what has been trailing collections throughout the year. Are you optimistic, Stephanie, that this will replay again in the current financial year as we get to the tail end? And is the government's decision, because if you look at the Supplementary Budget II numbers, it has revised the domestic borrowing target upward by double digits, a whole 24% to 589 billion shillings. Could this be a signal from the Treasury that, look, unlike the previous years, we don't see ourselves pulling in the weight we typically pull in from a revenue collection standpoint in June? Stephanie.
Yes, Julian. Now, like you've correctly mentioned, there is usually a traditional surge in revenue collections towards the end of the fiscal year that has been crucial in meeting annual targets. And one can correctly deduce that the government's recent decision to revise the local borrowing target by the double digits that you've mentioned, that's 24% higher for local borrowing, suggests that there's a potential concern regarding the revenue collections as we hit the tail end of this fiscal cycle this June. And this revenue concern is well noted in the Supplementary Budget II you're speaking of, to which the country's revenue performance had reportedly significantly fallen short of target by about, I believe it was about 200 billion Kenya shillings by the end of April 2024. This has since seen the National Treasury now revise its revenue targets lower by about 250 billion for the cycle ending this June, and thus the reliance on an increase in local borrowing just to bridge that revenue shortfall. Now, in hindsight, because this is quite reflective this session at this moment, there could be several factors that could have brought forth this revenue collection challenges as affected by the economic climate, tax compliance issues that Ruth has mentioned, as well as the government may just have been overly ambitious with their tax revenue targets. Now, for me, I just want to focus on not the ambition, but more so on what is concrete in terms of the economic climate and tax compliance issues. On the first issue around economic climate, I would just like to tie it into the climate change shocks that we've recently seen, i.e. from the heavy rainfall in the past couple of months that worked on disrupting business activity. We also noted a couple of months prior to that we had supply chain problems that were linked to USD shortages at the time that have since resolved, just to assure everyone, and as well as a lack of resolve around the payment of existing pending bills, which I'm quite passionate about. Now, on the payment of pending bills, I don't believe that there is a clear plan on how the government seeks to settle these bills, to which we have to appreciate that without the settlement of pending bills, it will continue placing a financial strain on businesses, which will have negative ripple effects onto the financial sector. And this has been highlighted greatly following the release of commercial banking results in Kenya. Now, just for effect, and it's important for me to mention this so that everyone is aware, that pending bills at the national level, I believe, amount to just at, is it 650 billion Kenya shillings? While at the county level, it's currently at about 150 billion. This means there's just nearly 800 billion that is owed in pending bills. So what does this mean for KRA? It just means that these businesses that are experiencing these cash flow challenges are less than likely to contribute to KRA's revenue mobilization efforts. So this needs to be quickly resolved, and I hope it's resolved soon. Now, the second issue is around tax compliance. And in the last financial year, that's 22-23, the tax compliance rate was estimated at about, I believe, 70%. And the government is seeking to raise this to 90% by the end of the 26-27 financial year. Now, in my opinion, improving tax compliance now starts by giving less attention to these reactive intervention strategies that we've been seeing KRA undertaking through various enforcement programs. And some of these programs are envisioned in the Finance Bill 2024, which include the use of financial data provided by banks, telcos, and other financial service providers. Now, we move from these reactive intervention strategies to more proactive strategies that would include simplifying taxes, simplifying procedures, and simplifying structures, as well as understanding, which is very important, understanding the factors that shape taxpayer compliance behavior so that a potentially more effective set of responses to deal with the underlying non-compliance is crafted and implemented. Now, just to end, and this has been highlighted by Ruth, is that you can't shy away from touching on the government spending when you're speaking about the revenue shortfall. Now, in the supplementary budget, it highlights that overall, both spending and revenue has been revised lower, but spending has been revised lower to a greater extent than the revenue. Now, what we've noted is that there's an increase in non-core, specifically expenditure such as travel in the supplementary budget, while the overall development spend has declined. Now, to note, traditionally, we have seen before spending cuts tend to be geared towards slashing the development outlay to a greater extent than the recurrent spend, which now becomes the reality we're living in, where we're seeing either a halting or delay of various projects, which can be costly at the end because this drags on for quite a bit of time. We have loss of employment during this particular time and loss of income, specifically for the informal settlements, to which our government, which is supporting the Hustler Nation, is quite aware of. So yes, Julian, that is the way forward in terms of that.
Stephanie, allow me to double click on a point you've raised around pending bills or state arrears. One of the characteristics of Supplementary Budget II 2023-24 is that it has absolutely no allocation for the settlement of pending bills. And this was very curious for me because, one, it comes within the context of the ongoing audit of pending bills, which is led by the task force, which is being spearheaded by the former Auditor General, that's Edward Oko. And I'm curious as to what inference you have made from this, because in my assessment, it could be a pointer that the audit has revealed we have such a staggering volume of verifiable pending bills that the state is now grappling with exactly how to sort them out. Because remember, when Kenya Kwanza came to power, the argument was we would securitize it in one way or another. And then they realized that we'll just add on to the debt burden anyway. So I wonder what you made of Supplementary Budget II having absolutely no allocation to pending bill settlement.
Yes, I agree with you. I believe that there was evidence that there's a huge amount that is verifiable, and there's need to settle these verifiable bills. That's the reason why there's no mention and no allocation. I just believe they're trying to figure out how to go about this, and that's the reason why they're using the pending bills verification committee that has taken so long to start verifying anything, to get the ball rolling. It's a concern. It's a real concern. as to how they're going to move forward. Most likely, as you said, collateralize it and debt, maybe. I'm not sure how they're going to go about it, but it will obviously have an impact on the government's debt burden moving forward, because that's the only way they'll be able to meet these verifiable pending bills.
Thank you, Stephanie. I can see Nicholas Kahiro from PwC has joined us. Nicholas, please introduce yourself.
Thanks a lot. Yes, I'm Nicholas Kahiro. I'm a senior tax manager, normally focusing on direct tax. Happy to join and have a discuss around budget that's about to be read. Thanks, Julia.
Thank you, Nicholas. And allow me just to stay with you as we continue with our reflection on the current financial year, that is 2024. Nicholas, we began this conversation by focusing on the question of the downgrade of the revenue. And one of the issues which has emerged in this particular financial year is that ordinary revenue in particular has had a struggle in 2023-24, having missed the target by a whole 255 billion in the first 3 quarters. And I'm curious, in your own assessment, is this largely a statement about the performance of Finance Act 2023? Or is it about the state of the economy, or what's the interplay between the two? Because ordinary revenue in this current financial year has had a particular struggle, never mind the raft of measures which were brought into force in the last financial year.
Thanks, Julian. And I can allude it to both of the reasons you have spelled out. First of all, remember all taxpayers are human beings and their rationale comes to their spending. So the aim of the government, as much as was to increase the revenue mobilization mechanism, most of the taxpayers also had their own other expenditures that are not a need, but rather a want. So as much as the government was keen to raise the taxes, which ultimately resulted in increase in prices, and then you also couple it with the inflation rate, which was a bit excessive, especially in the initial part of the year when we begin FY23. Most taxpayers opted to reduce the expenditure, cut some unnecessary expenses, which had a ripple effect into the economy, as well as into the tax collection. Secondly, if you look at the economy, as much as it's growing, remember there are still some pains taxpayers as well as businesses are feeling, especially due to the high interest rates, as well as the tight liquidity in the market through the pending bills, and as well as other factors coming into play. You'll find that people didn't have this disposable income. What they had to do is, if there's any price increase, for example, in a commodity, either you look for a substitute which is cheaper, or alternatively forgo buying the actual item or the commodity. This in turn has resulted into a reduction, especially when it comes to the consumer tax or consumption tax. People are avoiding to incur such unnecessary costs and focus on other things, especially their needs and one. Now, that coupled together with, remember, some of these provisions that were contained in the Finance Act 2023 were challenged the High Court level, or there was some delay in implementing the actual provisions. So those ones had also forced a delay in collection or remittance of those taxes that were being challenged at the court. Maybe that could be the reason why they were unable to meet the target they had set out earlier when they came out with the Finance Act.
But Nicholas, to be fair to the government, and I think we should give them their flowers here, whereas ordinary revenue has had a particular struggle in the current financial year, the fact of the matter is that appropriation in aid has literally played an offset role, kind of covering the gaps which have been created by ordinary revenue. If you look at the numbers from the National Treasury, A&A performance to Q3 was at about 117%, netting about 332 billion shillings. The question here is, do you see this momentum being sustained to the tail end? Are we likely to hit a home run, so to speak, with A&A when it comes to the close of FY 23-24?
I think it's likely to hit a home run when you're closing the FY 23-24. Fingers crossed it will continue in the same trajectory that it has been. I know the government has also hit some pointers in terms of also looking at it as a point of revenue mobilization, especially because of the outcry from the taxpayers and the raft of changes that were implemented and us not seeing the actual effect in the economy. So I foresee a situation whereby A&I will come and play a key role in terms of filling in the deficit, as well as can continue in the next financial year, which we are beginning in July. And hopefully it will sustain the same trajectory and it will help in assisting in filling in the gaps that we are seeing on the ordinary revenues.
Thank you, Nicholas, for that comment. I want us now to pivot into the budget estimates for FY 24-25. Having set the context, based on the latest numbers that we have seen coming for the current financial year, that is FY 23-24. Let me start with Stella Swakei, who's joining us from SIB, that is Standard Investment Bank. And one of the things which we have noticed through Finance Bill 2024 is that unlike the preceding finance bills, it has tended to lean a lot more on indirect taxes in its proposals. And that's why there's a very aggressive cleanup of the VAT first and second schedule, that is with regard to exempt and zero rated. If you look at the Excise Duty Act as well, there's quite a cleanup being done there. So, Stella, I'm wondering, what did you make of this leaning with the Finance Bill 2024 within the context of the operating environment the economy is in? All right, I think maybe she cannot hear us yet. So let me flip that question to Ruth Mwiti, who's a tax consultant here. Ruth, Finance Bill 2024, leaning significantly towards indirect taxes versus what we have seen in the past. For example, Finance Act 23 was quite heavy on direct taxes. What do you make of this leaning by the government when it comes to angling itself for revenue mobilization in the next financial year? Ruth?
Okay, thank you, Julian. And when we talk about indirect tax, we are talking about taxes such as VAT and excise duty, like the way people or consumers pay VAT at the supermarket. So it is a good idea, in my view, one, because when you focus on indirect taxes, somehow everyone pays the taxes. But I think the biggest question is, what are these indirect taxes? For instance, the proposal to introduce VAT on financial transactions, a very heavy one. So my thinking is, yes, it's a good way to target a collection of taxes through the indirect tax mechanism. But of course, the government should look at where are they not getting taxes and how can they achieve that. The good thing about the indirect tax system is the fact that everyone gets to pay the tax. Recently, you had one of KRA commissioners talking about targeting the people who are making money, but they are not paying taxes. So indirect taxes definitely is the way to go, but listen to Kenyans on what exactly should you tax. Some of the very important items, for instance, financial services, for instance, the issue to do with the proposed increase of excise duty on money transfer services, those ones, it's not advisable to touch. But where they can look for ways to target the Juakali sector through the indirect tax mechanism, it's better. Why direct taxes at this point might not work is because, for instance, the income tax currently is at 30%. So when you target corporation and you target getting more than 30%, it might be a very hard sell. When you go to the employees, again, there is a graduated tax rate. So again, if you increase that beyond, then you decrease the disposable income of these individuals and these institutions. So indirect taxes can work, but they need to be looked at critically to ensure that you're not chasing businesses out of the country because you are overtaxing. Ensure that you look at what is working and make sure that it works. So my view is it is a good way, but don't tax everything. Don't tax the basic. Tax what is necessary and leave. And maybe even consider not having a very high VAT rate. I know other East African countries have a higher one, but I've also seen other countries which have lower indirect taxes, which when they are lower, you get that everyone will also comply in the form of that the people who are collecting these taxes on behalf of the government agents, like for instance, the supermarket, to make sure that they are also complying, make sure that at least you reduce the tax rate, net in more, and make sure that everyone pays. Because when you go the direct route, sometimes those who are not paying quite a difficult task.
But Ruth, if I could table a counter narrative to what you're saying, don't you see a challenge here in the sense that when you talk about indirect taxes, the question of progressivity then emerges because, granted, you are having lower administrative costs and you're reaching a lot more people, but then they don't tend to be equitable. And that is why the direct taxes tend to be graduated. So for a government which, in the spirit of Finance Bill 2024, has made a couple of efforts to ramp up disposable income through increasing the fleet of deductible allowances, whether it is SHIF and housing levy, etc. Don't you think then leaning significantly on indirect taxes then negates the very point?
You have a point, and I want to agree with you. I think my thinking is in the form of how does the government get to, because I am convinced that the idea or the increasing of these rates is to get to that person who is not paying taxes. So if government is able to get a way that does not harm other taxpayers, like I want to give an example, Julian, the example of eating. The introduction of e-teams on businesses last year and saying that these expenses are non-allowable, what that provision has done to most of the taxpayers is that the people who are required to provide that e-teams invoice, either one, they are shying away from issuing the invoice, or two, if they issue you with the invoice, they will bump up the cost. They will tell you that if I have to give you that invoice, then I will increase. So that person who has already been paying tax, again subjected to more tax. Maybe then to say that, yes, use the indirect tax mechanism, but give some relief to the people who are paying direct taxes. For instance, like employees, they already pay a lot of pay-as-you-earn on their salaries. So yes, they will pay the indirect taxes, but at the end of the year, when they file their returns, probably get some credits. Maybe that can work. I don't know, but I think.
Thanks, Stephanie.
So, like you said, there is what I would say schools of thought. Just allow me to use that phrase, schools of thought, that suggest that indirect taxes tend to be quite regressive and not progressive, like you mentioned, compared to tax reforms that focus on income and wealth. But then there's another school of thought, quote unquote, that states that, and there's a paper that I read around 2010, I think, that's when it was published, my research. So it was published, I think, around 2010, that stated that VAT proved to be an efficient and strong revenue booster, and that countries that impose this tax, that's VAT as well as any other indirect taxes, tended to raise more revenue than those that didn't. And complementary to that, you find that even some countries that implemented or introduced or increased excess duty and other sales taxes tended to be the simplest measure to raise revenues relatively quickly without fundamentally changing the tax system. So maybe this is what the government's approach is. They have an economic council that may be looking at this, and they're basing it on evidence-based research from other countries that have been able to collect tax revenues relatively quickly through indirect taxation regimes, as opposed to touching or significantly touching on the income tax rates. So yeah, that's my thinking.
Stephanie, allow me to stay with you for a minute, because one of the struggles I've had with the numbers which have been tabled for the estimates for FY 24-25 is that the same government which has downgraded its revenue target for the current financial year by a staggering 250 billion shillings is targeting 3.35 trillion shillings in revenue, of which ordinary revenue for the next financial year is projected at 2.9 trillion shillings. And when you look at those numbers, they are significantly ambitious, and history does not suggest we can scale numbers that fast year on year. I wonder where GOK is coming from with this sort of proposal, especially within the context of Finance Bill 24, Stephanie.
Perhaps if you look at it from the point of view of improving tax compliance, but also what I'd mentioned earlier around the reactive measures around enforcement. They're looking at enforcing and ensuring that more people pay tax and they're able to tap into those who were not paying tax before. So maybe from that point of view, but like I mentioned earlier, the government's tax revenue targets generally are quite ambitious, but maybe there's some reasoning there and a rationale around broadening that tax base, improving tax compliance through various mechanisms like e-teams, albeit it may beat the purpose, so I'm moving forward. But maybe that's the rationale. That's what I'm seeing. But again, they could be overly ambitious.
Nicholas, are you persuaded that there could be some sound rationale around the projections for revenue for FY 24-25, especially when you consider some of the challenges we have had with the much touted e-teams? Pretty much the whole of last week we had outage. if you remember the chaos we had in this market on March 20th when VAT returns were being filed and we could not auto-populate as envisioned by e-teams, KRA had to relax the rules. We went back to manual filing. Nicholas, are you optimistic?
I can see a way, or I can see maybe a hot train they are having. And one of the measures they have taken is they have done cleanup of the VAT Act, whereby they have really tried to remove or minimize the items that are zero rated as well as exempt. Another measure we have seen which has some potential impact is they have also tried to remove or reduce the exemptions in the Income Tax Act. And one big one they have tried to touch is around the IFB, which I see potential tax revenues being mobilized around there. Also, we have seen them touching the excise duty bit and increasing rates, especially for items that are highly utilized, like financial services. We have seen also VAT on financial services being brought on board. So I can see a way they are trying to increase their revenues, but as to whether taxpayers will be willing to incur or taxpayers will come up with a mechanism or forgo such expenses, now that's the most critical question that the government has to answer, especially being rational human beings, and we tend to minimize or avoid costs where necessary, especially when there are hard economic times.
But Nicholas, don't you see a poison chalice there in the sense that when you introduce withholding tax on IFBs, for instance, the net effect here is that GOK is raising its funding costs, because when investors finally look at these IFBs going to market, they will definitely price in that withholding tax. GOK has to choose. It can't have its cake and eat it. And if you look at the borrowing targets for the next financial year, we are leaning significantly on the domestic market, unlike what we have seen in FY 2024, where, of course, we had some bucket loads of concessional financing. And secondly, on VAT, here's why I'm skeptical about it. We were in this same position when VAT Act 2013 came into force. And the reason why it came into force was the cleanup of the exemptions and the zero rating. But over time, because of political interests, we ended up again expanding the list of exemptions and zero rating. So what confidence do we have that this time we shall stay the course, especially when you factor in that the reason why we're doing this cleanup is prescriptions from the IMF program, which ends in March next year? Nicholas?
I agree, especially on the first point. The government cannot have its cake and eat it too, especially when it comes to IFB, because you're likely to see an uptick when it comes to the infrastructure bonds, the coupon rate. And all the investors will want to ensure their return is guaranteed, and any taxes that are being included, they increase their coupon rate too much. But you can argue also on the flip side. Remember, the government has already cleared the biggest challenge. That was the Eurobond that was crystallized in June 2023. So we don't have, say, liquidity pressures in terms of settling any urgent. And already they have started debt management for the next Eurobond that's likely to crystallize. So we foresee a situation whereby the interest rates may start going down, especially as the government's pressures in terms of refinancing as well as settling future debt obligations reduce with time. And this one you can see net off with the appetite of the investors who will want to maybe in future invest in the IFB. So there might be an uptick immediately after maybe July. But I foresee government refinancing as well as the debt obligation reducing its time or coming to a reasonable base. And also remember, they're still getting approvals from IMF and World Bank. I foresee a situation whereby the net effect will be a slow reduction, and not as quick as it would have been if, for example, the IFB will still be exempted, but we might see a small reduction slowly as we go by. If you look at the second bit, where it comes to the cleanup of the VAT Act, I agree. The VAT Act 2023, one of its main tasks was to clean up. But over time, we tend to have a situation whereby as much as we clean up, there are other political forces, remember also economic challenges, or a certain need requiring us to maybe include something as exempt or zero rated. There has been a lot of back and forth around this, and IMF has been keen in terms of cleanup of the exemptions in the income tax, in the VAT. So I foresee a situation whereby with time, we're able to clean up, but as we go by, as we near elections, as we face other economic challenges similar to what we faced during COVID time, a situation whereby we see introduction of new items under the zero rating and the exempt schedule. It's a balance, it's a give and take. Remember, even the government, sometimes you look at the the economic situation at that point, the needs of the people, and you have to sometimes, and you say, give in or at least include some items for the sake of either sort out an economic crisis at that point or to save a situation whereby the taxpayers are facing a crisis.
Thanks, Nicholas. I want us to shift gears and look at the expenditure side of the estimates for FY 24-25. And one of the conversations I've had with my good friends from the National Treasury is around the size of the budget, because if you do the math, it comes to about 3.92 trillion shillings. And the argument being leveled here is that, look, we almost have a flat budget between 2023-24 and 2024-25, because currently we are at 3.90 trillion. Now we are moving to just 3.92, which, if you look at Kenya's history, looks like we have really tried to place a firm lead on how much we're growing this expenditure. And the question here is, are we finally finding a path to the elusive fiscal consolidation session we have been having as a country? Stephanie, if I could start with you, and then Stella Swakei, if you could be getting ready on it too. Stephanie.
Let me say that's a very complex question. There are very many angles to look at it. Are we on the path towards fiscal consolidation? I think it's easier said than done. It seems as if we are putting a lid on spending, but the focus should be on what spending we're putting a lid on. Like I mentioned earlier, in the supplementary budget, we are seeing an increase in non-core expenditure. So is it that development spending is being reduced? Is it being increased? So we need to be looking at where this budget is targeting. Is it targeting the right areas, thematic areas? Is it aligned to even the Kenya Kwanza government's budget? Are we able to achieve it? Is it also tied towards the very ambitious revenue targets towards next fiscal year? There's a way we can be able to look at it, but yes, based on the numbers, that we are on the path of fiscal consolidation. Whether we're able to achieve it is another question. I'll revert to Stella so she can provide more insight.
Just to answer first what Stephanie has raised on the issue of whether the government is spending more on the thematic areas, I do agree and observe that the government has looked at and channeled most of the budget to the thematic areas. And the areas that have benefited the most are the common ones that we've been seeing historically. We have the education sector, the national security, and we also have roads. And this one again is a keynote because the State Department of Roads has seen a slight increase because again, most sectors or departments have seen declines in the budget allocation. So for the Ministry of Roads, we are seeing a slight increment from 178 billion in the current fiscal year under the second supplementary budget to 199 billion in the FY 24-25 budget. But again, we can celebrate earlier now because we know the development expenditure and mostly on roads is usually the first target when it comes to the cuts in the subsequent supplementary budget. So is it this strides towards fiscal consolidation and looking at what we are spending on? I think it is. And we can cheer on the fact that it's again a step towards the right direction. But another thing that I'd also love to know on the issue again of development, I've observed that on most of the sectors, there's too much focus on recurrent expenditure. When you look at the education sector, we are seeing an increase in recurrent expenditure in terms of the funds catered to TSC and also the funds allocated to sectors or segments like HELB and also the old funding system for the old students or the students who had joined campus just before 2023. When you also look at the medical sector, which is also part of the thematic areas for the government, you get to see that we have a slight increase in the recurrent expenditure in that now the budget allocates or has something for the interns. And maybe we can say that this is a positive again after the doctors went on strike on behalf of the interns. But again, when you look at the development side of that particular sector, you get to see that most of the development, especially at county levels, in terms of new facilities, advancing and also trying to do maintenance and repairs, this particular segment on development has greatly suffered with regards to the financial year 2024-2025 budget. So my 2 cents are just to agree with what Stephanie has said. Where is the budget being cut? So at the expense of development and everything else. We are focusing more on recurrent expenditure and ignoring or neglecting the part of development. I think, or I feel like this is something that will catch up with us later in terms of the facilities that we have at both county level and the national level.
Allow me, Stephanie and Stella, to stay with you for a minute. And don't you think we really need to cut the government some slack on this issue of trimming development expenditure? Because if you read reports on the revenue outturn and expenditure performance, you will always note particularly low absorption rates when it comes to development spending, vis-a-vis recurrent spending, and a number of reasons are always floated, especially the fact that the procurement exercise in this country is quite lengthy, it's quite daunting, and that's because our procurement process is designed to be an anti-corruption process just because of some of the tendencies we have as a people. And even if it were you sitting on the 14th floor of the National Treasury, Stephanie, when it comes to where you would slash first, you would begin by slashing where you see funds are largely underutilized, wouldn't you?
From what you've mentioned, of course, that's how you look at it rationally. I always look at the government like running a business. So wherever it's underutilized, that's where you slash first, focus on is maybe more meaningful or where their needs are more pressing. That would be, or maybe on the recurrent spend. But then you'll find as you move along, other spending comes along, which is non-essential. As you slash the development spending, that's when you start seeing an increase in non-core spending. Let's say travel, trainings, just before the cycle ends, which has become a recurrent issue in our government of Kenya over time, not just this government, but generally across the board. So that is the issue that I have, is that why don't we improve our procurement process? Why is it taking so long to improve it? Because it's an issue that has been there since time immemorial. Why can't we just improve the process and ensure that we can actually get things done on the development space and stop reallocating these funds elsewhere to what I say is non-core spending?
Thank you, Stephanie. Stella, anything to add there before I move on to something else?
Yes, Julians, I agree with Stephanie on that. And I feel like we can be able and focus more on reducing the pilferage on the side of recurrent expenditure, because again, we've had and seen through the auditors, the General Auditor's Office and also the Controller of Budgets Office, we've seen complaints and the two raising and flagging pilferage and wastage and misappropriation of funds. So I think if we focus on that particular area, we will be able to have more funds to channel and to allocate on the development side.
Thank you, Stella. Allow me now to come to Nicholas and Ruth. Nicholas, let me start with you. One of the interesting things about this pre-budget cycle in the current season is the fact that while we were right in the midst of Finance Bill 2024 and the submission of comments from the public, the National Treasury decided to make public sessional paper number 2 of 2023, which is the national tax policy. Now, we have talked about the national tax policy in this country for a long time, and we finally saw the final version through sessional paper number 2. Does the sequencing of its release strike anything for you, Nicholas, that it's coming right at the heart of the fact that we are deliberating on Finance Bill 2024? And if you consider, for instance, there are stark variances between the two documents. So, for example, the national tax policy tells us that as a matter of policy in this country, excise duty incurred in inputs should be allowed to offset the excise duty requirements on the final product. Finance Bill 2024 is proposing a repeal of Section 14 of the Excise Duty Act, which provides for precisely that. So there is a bit of misalignment there. Was this timing the Treasury just trying to tell us, look, we have seen you, we have heard your cries, especially on things like this, and don't sweat about it. We are already working on addressing it. Nicholas.
Thanks, Julius. Yeah, the timing was opportune, and we do commend the government because it's one of the items as tax practitioners as well as taxpayers working on in terms of us having a national tax policy which is anchored in line with our Vision 2030, because a document that should speak when it comes to us formulating tax laws, and it should be our guide, especially when you want to tax, maybe for example, a certain form of income, coming up with new tax legislation. It should be our guide and it should be coherent or should speak towards our economic vision. In terms of inconsistencies, yes, as the first one you had alluded to, we have seen a statement by some of the things what we were expecting that were contained in the national tax policy that ought to have been reflecting in terms of the tax proposals or provisions that we are trying to push. But the problem is, remember, also there was a medium-term revenue strategy that was also released by the government in between these discussions of budget. Is it a common thing that we should embrace? No, I think the government should make sure they align all the future tax proposals in line with the national tax policy, as well as try and anchor them towards the medium-term revenue strategy. Because the beauty about having a national tax policy, it creates an element of certainty. Taxpayers are aware, they can preempt the thinking of the government, the priorities of the government, and you're in a position whereby you know you will have this. For example, if we have a change in the Any Tax Act, we have a situation whereby I can preempt and say for the next 5 years, I'll be able to enjoy these tax relief or these tax incentives that the government is trying to push. And with tax certainty, it now fosters or it enables investors out there to invest here in Kenya, as well as local investors who have that impetus because we have certainty. Another thing about us having a national tax policy that we should also look forward to is a matter of making it for easier solution of tax disputes. Because remember, the beauty about our national tax policy, it speaks about what is the spirit, what is the government trying to aim to when it's formulating or when it's coming up with its policy. In fact, that when we go back and come up with a tax provision, and there's an element of ambiguity in that tax provision, we can default back and say, this is what the national tax policy speaks to. Is the provision speaking to the spirit of a national tax policy? If not, then we should default with the spirit of a national tax policy. And that's the beauty of having a national tax policy, and hoping when in the future finance bills or finance acts that are published, we should be having our finance bills speaking towards the national tax policy.
Nicola, just a quick follow-up to the point you've raised around the national tax policy, the certainty, especially around the subject of dispute resolution. And one of the things that I've struggled with when I look at the national tax policy and Finance Bill 2024 side by side is, for instance, Finance Bill 2024 is proposing an amendment to the Tax Procedures Act, whereby if you are not integrated with ATMs as required by law, then you should be subject to a penalty of 2 million shillings every single month. Never mind, we have a Tax Procedures Act, which is very clear on the penalties for non-compliance. How exactly does this work? Because we have structures in place, we have clear guidelines in place, but on the other hand, we have finance bills which are always coming and bordering on overreach when it comes to tax proposals.
Yeah, one of the key measures you will notice or realize in this current finance bill, they have tried as much as possible to empower KRA, and also when it comes to ATMs, make it very punitive if the event you are unable to onboard or issue ATMs compliant invoice. There has been that conflict, especially the 2 million that's being levied every month. You fail to adhere to the ATMs, and subsequently another provision splitting other penalties when it comes to the non-compliance of ATMs under the TPA. With the current conflict, we foresee a situation whereby we'll see a dispute, especially in the near future when KRA starts assessing or reviewing, which we foresee it will be around early next year, because that's when the first time we'll be filing in our past returns. And we expect an outcry from most taxpayers, mainly because, one, there have been multiple solutions that have been rolled out by KRA. Some of them are unable to address some issues that taxpayers are facing. Secondly, we have some taxpayers outside the major cities, that is the Nairobi, Kisumu, Mombasa, Nakuru, Eldoret, whereby at least there is good internet, there is good awareness of IT. So you can say their compliance will likely to be higher. But outside those major cities, we foresee a situation whereby people struggling to understand, people accessing the internet, as well as the normal challenges that were alluded to when there are downtime on KRA systems. What means to the taxpayers? One, chances are we expect a lot of invoices being disallowed, especially for those ones who their suppliers are yet to embrace ATMs 100%. A second, now enforcement of those punitive penalties that have been imposed. And those ones, like paying 2 million per month, in a year we are looking at 24 million. That's quite substantive, especially for SMEs. Because remember, the bulk of the corporate chances are they have resources, they have expertise, but now the SMEs and people below that SME radar, those ones will face a hard time trying to have conversations with the tax authorities as to the non-compliance with the e-teams, as well as the issue around the system challenges they are facing. So I foresee a situation whereby tax disputes around e-teams rising, as tax liability from a corporate tax perspective increasing time, especially with KRA, if they don't allow taxpayers to be in a position to claim tax deductions on those expenses.
Thanks, Nicholas. And just so that we're all on the same page, when Nicholas talks about expenses disallowed, he basically means that when you're finally doing your income tax filing, then you'll not be able to deduct those expenses incurred before you arrive at what is your taxable income. Ruth, very quickly, what were your immediate thoughts when you saw the national tax policy, especially when you look at it side by side with the medium-term revenue strategy?
As you said, we have really waited for this national tax policy, and from my assessment, it looks like it is to a very great extent agreeing with what tax policy should be there in terms of a review of the laws within a period of 5 years, making sure the law is easy to understand, being predictable. But now when you look at side to side, then it gives conflicting information, because on one side, government is telling us that the tax policy needs to be implemented, and these are the provisions, and this is how the tax law should be. But on this other side, it is doing the exact opposite. And I would give an example of some of the proposals, actually some of the provisions that were in the Finance Act of 2023. We are seeing barely less than a year, some of these provisions being reversed or some rates being increased even before an expiry of 1 year period. So the question then is, government saying one thing on this side and going against that on the other side? I feel strongly that this national tax policy should be implemented, and in addition to being implemented, followed. Because if you are going to have invest in the country, then the law needs to be predictable. You cannot be changing the law every single year and you're expecting these investors to come in and stay in the country and do business, because we have seen in the media a lot of stories going on about certain investment company closing down. And of course, not a good thing. So how do you make sure that you are doing what the national policy says? So my view is that, yes, introduce the tax policy, but make sure that whatever the tax policy is saying, if you're going to review laws every 5 years, then go by that.
Thanks, Ruth. And maybe that's a good way to segue now to Stephanie, because many of us read the phrase review these laws once every 5 years. And the question that was inundating my ex inbox was, are we saying then that we shall be seeing finance bill once every 5 years? Stephanie, I don't know what you miss.
Actually, let me revert that to the tax experts, because I actually did not see that, or Stella. I didn't really internalize that. So either Stella or Ruth or Nicholas can be able to answer that.
Nicholas, any thoughts on that bit? Because many Kenyans have asked me, does this mean that we shall be seeing the finance bill once every 5 years? And my argument, and I could be wrong to them, has been that, look, the PFM Act and framework in this country is very clear that you shall be seeing a finance bill annually. But what this is saying is that if we change excise duty provision in a certain clause this year, we will not change it until we have some 5 years runway, until we have certainty around it, how it has performed, the lessons taken. Then we can revise it after 5 years. But we shall still see finance bills every year. But I don't know what your thoughts are, Nicholas.
Yep, I'm aligned with your view. So we should be seeing the Finance Act on a yearly basis. But if we amend a certain clause or a certain provision in the tax legislation, we give it time, 5 years. Let's assess its impact after 5 years. Did it work? Did it achieve the internet goal? And then from there, that's when they can revisit it. There will be some instances whereby the impact is so advanced, there has been an outcry. They could amend it, but that one should be on a very exceptional basis. It should not be a recurring or a regular item that we are seeing.
Ruth, anything to chime there, or we switch gears?
I agree with you and Nicholas. The Finance Act, I think we should be still expecting the Finance Act, but majorly to review maybe those proposals that were in the previous year that are not working, but not to introduce very major amendments that have an impact on taxpayers. So give it time. If it is working, move with it. But if there are any challenges, then review to make sure that taxpayers are happy and government is happy.
Thank you, Ruth. I want us to get to the tail end of this conversation. And now let me move to Stephanie and Stella. One of the things that has jumped out at most of us, or at least myself, when you look at the budget estimates for FY 2024-25, is the question of the deficit, because we are talking about slashing the deficit from about 920 billion shillings in the current financial year, based on Supplementary Budget II numbers, to 514 billion shillings in FY 24-25, which is a considerable slash. By my math, is the first time in about 6 years where we shall be coming something close to the East African Community Convergence criteria of targeting about 3%. Stephanie, I don't know whether you have a measure of confidence that we will actually be able to hit this deficit target, because of course, where the government is coming from with this is that the question of the deficit has been a very core pillar of the current program with the IMF, and one which we have struggled to meet every time.
Will we hit 3% next year? No, I don't believe this is the case. Looking at what is on paper, the deficit reduction is in line with higher revenue estimates and a moderate increase in expenditure. So it's back to the overly ambitious tax revenue or revenue estimates that we are seeing. Whether we'll be able to achieve it is another question. So on paper, it looks good. Whether we'll be able to hit the revenue target owing to the different combinations of higher indirect taxes and increased tax compliance is a key question. But also whether we'll be able to tame our spending within the next year is also a greater question. We have a number of bonds that are coming up for maturity within the next year, which is going to highlight a major concern around our debt sustainability and our borrowing capacity. Going back, there's requirements for more debt. How are we going to be able to facilitate this? So there's a lot of questions around there. But on paper, it looks good. Whether we'll be able to achieve it is another question that I'm highly skeptical, but I am optimistic. I would like to be optimistic with what's happening with the government. Since we live in Kenya, it's better to be optimistic than pessimistic, as we hope to be impressed in the next fiscal year.
Stella, your thoughts on the question of the deficit for the next financial year?
I agree with Stephanie that this is a function of overly ambitious revenue target. And if you can remember well also, for the current fiscal year, the first proposal for the budget, our deficit was at around 718 billion thereabouts. So how we moved from that to 920 and now to 908 again, it's not a mystery. We know that the government has been ambitious in terms of setting the revenue targets that it expects to collect. And I still also think that they will not be able to achieve the revenue targets for the current fiscal year. So again, this obsession with increasing tax to GDP, I also believe that this is one of the factors that is leading or fueling the aspect of having the overly ambitious revenue targets. And if you look at it or you observe from a historical point of view, you get to see that, for example, the reason why our tax to GDP has been declining, for example, since 2013 to now, where we are at, we've seen our GDP being rebased, like I think twice, in 2014 thereabout and 2021 again. So after every rebasing, we've seen the GDP increasing. For example, when it was rebased in 2014, we had an increase of around 25%, then a bit modest increase in 2021 of around 5.5%. So when you look at it from that perspective, that revenues have been growing. We have all seen that. It's not like our revenues or taxes have been stagnating at one point. We have the revenues growing, but the GDP is also growing. So what I observe or deduce from this is that maybe much of the taxes are getting lost in the informal sector. So I feel, and I hope I've not gone away from the question, I'm just trying to address the issue of why I feel like the government is always ambitious in terms of the revenue target. So I feel like that is one of the reasons, and one of the ways that we can be able to increase our tax revenues and maybe meet these ambitious targets and depend less on debt and external financing and also domestic financing, would be trying much harder to bring in the informal sector to the tax base. So again, to answer the question, I believe that towards the end of the fiscal year 24-2025, or even in the supplementary budget, that is the first one and the second one, I believe that there will be an increase in the deficit or in the borrowing targets for that particular fiscal year, because from where I sit and from the analysis and observation of where we are currently, I don't believe that the Finance Bill 2024 will be able to raise more than 600 billion. And still, I do not believe that we will be able to achieve the current fiscal year's revenue target and also the next fiscal year's revenue target.
Thank you, Stella. I want to open the floor for any questions that might be there. Eric, do we have any questions we can take before we get to the last leg of this discussion?
We don't have questions yet, but I'm checking a little bit. So, but if you have any questions, you can DM us or tag us, and then we'll be able to pick them up in a few.
Thanks for that, Eric. So as we get to the close of our conversation, we have about 13 or so minutes to go. I'm very curious, Nicholas, to get your thoughts around one question, and Ruth as well. Currently, we have the Voluntary Tax Disclosure Program, and we also have the Tax Amnesty Program running side by side. Both of them have their sunset date on June 30th, 2024. From the latest numbers we have seen from the Revenue Authority, the tax amnesty has not performed as well, perhaps, as was expected. Going into 24-25, we will not have these two at play. And I'm wondering how you see that impacting the revenue outturn for the next financial year. Nicholas first, then Ruth second. Nicholas.
Yeah, the voluntary tax disclosure together with the tax amnesty has been playing a key role. We have seen numerous taxpayers trying to enjoy or to ensure they are able to regularize their tax affairs before the expiry of the same. Watch out the collection for this month from KRA. There will be a huge increase, and mainly it will be driven by both the tax amnesty and the voluntary tax disclosure, because we have seen activity increasing over time. Now, coming to next year, the bump of June, especially for this month, next year, will be a bit lower, mainly because of the unavailability of the tax amnesty together with the voluntary tax disclosure coming to its sunset. So we will expect at least most of the taxpayers have tried to enjoy and regularize their tax affairs before the sunset. However, the revenues might be subdued because of close of the tax amnesty and the voluntary tax disclosure program. But I foresee a situation whereby the finance bill has already started putting some clauses that empowers the commissioner to abandon certain taxes in the event of difficulty. We are hoping the government can at least increase the powers given to the commissioner, not only to look at where a situation whereby taxpayers have faced difficulty, such that that's the only position that they can grant waivers, but where tax has volunteered themselves and they want to regularize their tax affairs to be granted some form of dispensation, be it certain threshold that's approvable the commissioner's level and a certain threshold be approved at the National Treasury level or Parliament level. Although more we have measures that allow waiver of penalties and interest, it creates some impetus on taxpayers to voluntarily declare where they have been non-compliant or where they have still maybe it was because of review or different interpretation of the tax provision, give them impetus for them to come and declare if they get a change of mind.
But Nicholas, very quickly there, I took a different view because I was wondering to myself, what is the point of Finance Act 2023 doing away with the powers of the commissioner to be able to extend waivers, and then Finance Bill 2024 reversing the same provision? Where's the predictability in all this? Even if I benefited from a waiver under Finance Bill or Act 24, what certainty do I have that in the next financial year it won't be reversed again?
And now we default back to us having a national tax policy. I think, first of all, it was wrong deleting that clause, because remember, any tax administration system must ensure there are powers granted to the commissioner to waiver penalties and interest, such that we are able to foster compliance through waiver of penalties and interest. Now, with the introduction, it's a welcomed move, but now it creates that notion in the back of the minds of taxpayers. How sure am I to not be deleted next year when you have the next round of the finance bill. And that's one of the key issues we have been agitating as tax practitioners. Let's have consistency, let's have predictability. And with the national tax policy out, I would urge the government to make sure going forwards, let us anchor our changes, our amendments in the tax legislation with the national tax policy.
Thank you, Nicholas. Ruth, are you there? I can't see you on my page here. Okay. As we wait for Ruth, I want to invite my panelists to take us through their closing thought on this discussion on matters pre-budget 2024-25. Remember, we started by taking a rear view look at the current financial year, that's 2024, and the revenue downgrade and what that means. Then we came and looked at the budget estimates for 24-25, both on the revenue and the expenditure side. We have closed by looking at the deficit question, as well as provisions which are hitting their sunset in June this year, and therefore won't be there in the next financial year. That is something around the question of the voluntary tax disclosure program, as well as the tax amnesty. Before I invite my panelists to give their closing remarks, Eric, do we have any questions to be raised?
I think most of the questions have been covered in the process of the discussion, so we don't have any questions yet.
Awesome. Thank you for that, Eric. So we have 6 minutes left. I want to begin by taking closing remarks. Let me start with Stella. What are your closing thoughts as we look ahead to Thursday, where the CS will be giving us the budget speech?
As we look ahead or forward to the budget speech on Thursday, I feel like we should not expect much of any changes in the budget in terms of the allocations, as I had said earlier, because most of the sectors or departments have more or less the same of what was there in the previous year. And again, we should not expect much of a change in terms of development, in terms of our facilities and everything else with regards to development. We should not expect much of that because, as we have insisted and stressed before, much of our revenues, or a huge chunk of our revenues, are weighed on by the repayment of our debt in terms of principal and even interest payments. So the current fiscal year looked like it was the worst because of the Eurobond repayment, that is the 2024 Eurobond. But again, this is past us, but still the debt servicing obligation or the budget allocation is still higher for the next fiscal year because of the interest payments and mostly for the domestic debt space. Because again, as we have noticed and as observed in the past 1 or so years, interest rates have been extremely high in the domestic market. So this again will weigh on the revenues in the next fiscal year. So my closing remark would be, let's not expect any much difference of the budget from the current fiscal year to the next fiscal year. You will see an issue with debt servicing with regard to that particular segment weighing on the revenues. Otherwise, I'm glad to be part of this conversation, and I hope we've learned, and I have learned from my fellow panelists. Thank you and have a good night.
Thank you, Stella. There, I want to invite Stephanie. I'll invite her. There's a question which has come here. And the question here is, why are we obsessed with bringing the underground economy into the tax base, keeping in mind the underground economy offers shelter during a high tax regime and high regulatory environment? There's also the fact that the government spends all it can tax. So the question here really is, we seem to have an obsession with roping the informal sector into the tax net. Why is this the case, and why should we be concerned about it? So Stephanie, as you give your closing thoughts, if you could respond to that, I'd appreciate it. Thanks.
Thank you, Julian. I won't necessarily say that it's a concern that we are roping in the informal economy. It's just that, and this is an approach I've taken over time, is that the approach we take in roping any business, consume any, like the informal economy in total, is that we need to take a staggered approach. Don't lump everything all at once. And that's one of the failings I feel has come forth from this current regime in terms of lumping everything at once, even whilst the economic times are quite hard. It is not a bad thing to rope in the informal economy. It's actually the largest sector, the largest employer in this country. It's important to give Caesar what is due to Caesar. But as I said before, and everyone else has reiterated, what the government does with this money is what matters. And in my final remarks, I would like to emphasize what Stella has mentioned, that the budget reading, in my opinion, will be a non-event. There's not much that will change in terms of the numbers that we've already seen. However, what I would love to come out from the budget reading is the government's commitment that political goodwill and the political commitment that they will be walking the talk and just assuring Kenyans that we are with you. Because what I have been feeling in the past couple of months, even through this whole public participation for the finance bill, is that there's a bit of a disconnect from what the government expects or thinks is happening on the ground vis-a-vis the reality. So that government goodwill, the political goodwill, the commitment needs to come out quite strongly. Because one thing we need as a nation is just that commitment. Whether it comes through and people buy into it is another question. And that's why I'm saying about walking the talk. So for the government to walk the talk is very important. And I hope it comes out quite strongly in the budget reading and subsequent months for the next fiscal cycle. Thank you.
Thanks, Stephanie. Nicholas, your closing thoughts?
Thanks, Julian. Thanks for this opportunity to have this discussion. And as we head towards the budget reading, hoping and praying that best views of the Kenyans have been heard, especially after this public participation. I'm optimistic the outcome of the Finance Act will encompass the views of the taxpayer together with the views of the Kenyan. I know the government is in a difficult situation whereby we need to increase your revenues. There are these demands from an expenditure side. It's purely a balancing act. And our prayer is, as what my colleagues have alluded to, let's have that political will and also let's be, can you say, sincere to everyone. To ensure whatever we task ourselves or whatever we go after, let's be sincere. I think I'll pause there and I'll hand over to you, Julian. I've seen Ruth has come back.
Yes, Ruth, give us your closing thoughts, please.
My apologies for that. What I can say is that there are laws currently that have been made or developed to collect taxes: the Income Tax, the Excise Duty Act, the VAT Act, and in terms of administration, the Tax Procedures Act. My view is that we don't need to keep on changing the law with a view to increase revenue. I am of the view that if these laws, the way they are implemented, government can be able to achieve the tax that it is looking for. Why? We have the income tax, which provides for taxation of corporates and individuals. Are we, or is KRA, or is the government doing enough to make sure that they collect from those registered taxpayers? Because this changing of laws from A to B or from 15% to 20% is what is making so many taxpayers make a lot of noise and be attained. But when we have laws that are already there, and they are followed to the letter, they can collect revenue. To the question or to the comment that you had, Julian's, on the ongoing tax amnesty, I feel that it was a very good proposal. Yes, it's coming to an end, but I also feel that there was no need to remove the provision that allowed the commissioner to grant waivers. Reason being, sometimes payers have very genuine reasons of maybe delaying to pay taxes. Some could be issues to do with ongoing disputes and maybe issues to do with the interpretation of the law. Taxpayers should be allowed an opportunity to make an application for waiver, and the commissioner should be given now the leeway to make a decision on is this a valid case or is it not a valid case. But scrapping off that provision in entirety, in my view, is not fair because of those genuine issues.
Ruth, thank you so much for being part of this conversation. Thank you so much to my panelists, that's Stephanie and Nicholas from PwC, as well as Stella from SIB. Thank you so much for your insights in this pre-budget analysis. We all keep our radar now on Thursday, though as has already been stated, it really is a non-event. We have the numbers already. We're just expecting a few tweaks here and there. So let's stay on a lot and keep raising these issues. I hope we all submitted our comments on the finance bill. Let's wait for the report from the National Assembly Finance and Planning Committee. And thank you so much to the Mwango Capital team. Eric, over to you.
Thank you so much, Julius, for hosting the spaces, and thank you for the panelists. Also, keep tracking Julius' timeline. He has quite a lot of information in the past month or so, and if you get lost, you can always come back to these spaces, which will produce as a podcast soon, so that you're able to listen to it once again. It's very important to participate in the budget making process. As Julius points out, make sure that you're plugged into the whole process from the inception to the very end, and even beyond that into the finance bill and the Finance Act as it comes into play. Thank you once again for the panelists. And Julius, you're a very busy man, so thank you so much for the 1.5 hours you spared us today. Hope to have you again soon to analyze more of this kind of content. You really break it down very well. So I'm very appreciative of your time.
Asanteni sana. Thank you.
All right.
Goodbye, everyone.